Here are 5 particular IRS documents that the typical American retiree over the age of 65 has never once submitted throughout their lifetime, and each one of them has the potential to deliver thousands of dollars directly into their hands before the year wraps up on December 31st. 5 documents sitting on the IRS website at this very moment, completely free of charge, accessible to every senior born before 1961, and nearly everyone is overlooking them. Before I move even one step forward, I need to address the single greatest misconception, because it is the exact reason most retirees stop watching and walk away from thousands of dollars left unclaimed. Some viewers assume that a video about IRS documents is only relevant to seniors who are in financial hardship. So if they feel financially stable, they click off. Others believe it must be some sophisticated wealth strategy designed for wealthy retirees. So if they're living primarily off their Social Security income, they also tune out. Both of those assumptions are completely mistaken. This list applies to every senior born before 1961. Whether your entire household income is a single Social Security payment, or you receive a pension, hold some savings, and own a home that has tripled in value, there is genuine money sitting inside these 5 documents, with your name attached to it. The reason almost nobody mentions these to you is painfully straightforward. The IRS does not promote tax savings. Your accountant does not receive additional compensation for filing these on your behalf. And the deadline is real. Over the next 24 minutes, I am going to guide you through all 5 of them, one at a time, in straightforward, everyday language. Document number 1 is coming your way in just 4 minutes. But stay until the very end, because document number 5 carries the greatest impact of all, and it is the one document that nearly no retiree even knows is available. Here is the uncomfortable reality about these 5 documents. The IRS does not telephone you and remind you to file them. Your tax preparer does not automatically include them in a standard senior tax return. And every single one on this list either lowers what you owe or accelerates what gets returned to you, which means the systems that collect your money have little financial motivation to stay silent, but absolutely no obligation to speak up on your behalf. Think about it honestly. Every dollar you fail to claim is a dollar that remains inside the system. That is not a conspiracy theory. That is simply how a passive tax code operates. It rewards the people who know to take action. It quietly drains from the people who do not. There is another reason these documents go unfiled year after year. Most seniors were raised their entire lives with the belief that the IRS is not an agency you want to provoke. So they hand their paperwork over to whoever charges the lowest fee, sign wherever they are instructed, and simply hope everything works out. The problem with that approach is that hope is not a tax strategy. If you have ever questioned whether your tax preparer is actually filing everything you legitimately qualify for, hit the like button right now. Just 1 second of your time. It signals to me that this type of content is worth continuing to produce. Now, a quick but important note. This video is strictly for educational purposes and does not constitute tax or legal advice. Tax laws are complicated and situation specific. Always work with a licensed CPA or enrolled agent regarding your personal circumstances before making any decisions. Quick question before we arrive at document number 1. Have you ever come across any of these 5 documents before today? Just type yes or no down in the comments section. I read every single response, and it helps me understand who is being served well by the system and who is quietly being failed by it. Before I hand you document number 1, here is something I want you to hold in mind. At the 22-minute point of this video, I'm going to walk you through a real-life scenario where one of these 5 documents saved a retired woman living in Ohio more than $4,000 within a single calendar year, beginning the very month after she submitted it. She had absolutely no idea the document existed before then. Stay with me. One more piece of context before document number 1. Every document I am about to present to you has been verified directly through irs.gov or ssa.gov. I will give you the precise document number, its exact purpose, and where to locate it so you can confirm everything yourself. Every item on this list is real and waiting for you to claim what belongs to you. Document number 1. This is the single most overlooked document in the entire IRS library, and it is the one that returns the most money directly back into your monthly income the quickest. Form W4P available at no cost at irs.gov. This document controls how much federal income tax is withheld from your pension, annuity, or IRA distributions each and every month. Here is the core problem. When most pension programs and IRA custodians establish distributions, they either apply a default withholding rate, which is almost universally set too high, or they never ask you a single question. They simply apply a generic formula that assumes you are bringing in more taxable income than you actually are. So what is the outcome? Every single month they hold back more than you genuinely owe. Then, come April, you receive a refund and you feel relieved or even pleased about it. Most people do. But consider this. That money was yours the entire year. You simply provided the government with an interest-free loan for 12 months. Consider a retiree. We will call him Gerald. He is 67 years old, single, and residing in Tennessee. He draws a $40,000 annual pension. His custodian is automatically withholding 10%. That amounts to $4,000 per year held back from him. But because Gerald is 65 or older, with the updated senior bonus deduction introduced under the One Big Beautiful Bill Act, his real federal tax liability on that pension is closer to $1,500, not $4,000. That is $2,500 he has been lending to the government each year without any return on that loan. That translates to more than $200 every single month that should be sitting in his own bank account rather than waiting with the IRS until April. Form W4P is the solution. He downloads it from irs.gov, completes the straightforward withholding worksheet, and submits it to his pension administrator, or IRA custodian. His withholding adjusts the very next month, not next year, the following month. While we are still on document number 1, a quick question for the comments. Are you currently having federal income tax withheld from your pension or IRA distributions? Yes or no? I am putting together a follow-up video on precisely how to calculate the correct withholding figure for your specific circumstances. Your response tells me exactly how many people genuinely need that guidance. But here is what makes the next document even more impactful. Because document number 2 does not address your pension at all, it addresses your Social Security payment, and the default setting on that document is costing millions of seniors money every single year. Document number 2. This one is relevant to anyone who is currently collecting Social Security, and it is the document that determines whether the government holds your money for an entire calendar year before returning it to you as a refund, or whether you receive the correct amount deposited every single month. Here is something the majority of seniors are completely unaware of. Social Security payments are delivered with zero federal tax withheld by default. Not 5%, not 10%. Absolutely zero. Now, for certain seniors, that arrangement is perfectly acceptable. If your provisional income is low enough that none of your Social Security benefit is subject to taxation, you are in fine shape. You have no need for withholding. But for the millions of seniors whose Social Security is at least partially taxable, that zero withholding setting creates a deeply unpleasant shock every April. They discover they owe considerably more than anticipated. Sometimes the amount owed is quite substantial, and in certain situations they are hit with an underpayment penalty on top of the balance owed. All of this because they were never informed that Form W4V even existed. Form W4V gives you the ability to select your Social Security withholding rate. You have exactly 4 options to choose from: 7%, 10%, 12%, or 22%. That is the complete list. You simply select the one that aligns with what you actually owe. Here is why this matters from both directions. Some seniors are under-withheld. They receive an unexpected tax bill every April. But other seniors are significantly over-withheld. They selected 22% when their actual liability was closer to 10%, and they have been overpaying by hundreds of dollars every single month throughout the year. Consider Dorothy. She is 69 years old and married. She and her husband both collect Social Security. Their combined benefit totals $36,000 annually. Her husband established 22% withholding several years ago when their combined income was considerably higher. Now, given their current deductions, their actual tax rate on that Social Security income is closer to 10%. They are overpaying by roughly $2,500 every year in withholding alone. That is $200 every month that should be sitting in their checking account instead. Submitting a fresh Form W4V to SSA.gov resolves it. You can submit it directly through the online portal, mail it to your nearest Social Security office, or deliver it in person. It adjusts your withholding on a going-forward basis. Now, here is something I have not yet mentioned about these documents. 2 of the 5 on this list were created specifically for seniors aged 65 and older, not general taxpayers, not working-age adults, specifically and exclusively for you. I will get to those shortly, and one of them is document number 3. Stay with me, because document number 3 is the one most CPAs do not automatically file, and it is the document that was built specifically and solely for individuals born before 1961. Document number 3 is the document that was literally engineered with you in mind. Form 1040-SR. The IRS developed this specifically for taxpayers aged 65 and older, and millions of seniors continue submitting the standard 1040 year after year, entirely unaware that a senior-specific version even exists. The SR version features larger print. That is not the most significant aspect, though it certainly matters. What truly matters is what is built directly into its design. Form 1040-SR includes a dedicated section for calculating the senior bonus deduction, introduced under the One Big Beautiful Bill Act. That is the $6,000 deduction for single filers born before December 31st, 1961, and the $12,000 combined deduction available to married couples where both spouses have reached age 65. It also features a more organised layout, specifically for reporting Social Security income and pension distributions, which represent the 2 most prevalent income sources for retirees. The standard 1040 does not include those dedicated sections. You can technically claim everything using the regular form, but it is considerably easier to overlook things, and most tax software still defaults to the standard return. Here is your action step. If you work with a CPA or professional tax preparer, ask them one direct question before you sign anything on your return. Are you filing my return using Form 1040-SR? If the answer is no, ask them to explain why not. If they cannot provide a clear and satisfactory reason, treat that as a warning sign. If you file your own return using tax software, look for the option to switch over to Form 1040-SR before you hit submit. Most major tax software programs support it fully. It may appear under the label Senior Return, or you may simply need to check a box confirming that you are 65 or older. A quick reminder that this video is intended for educational purposes only and does not constitute personalized tax advice. Always consult with a licensed CPA or enrolled agent regarding your specific situation and financial circumstances. Now, document number 4. If you are finding genuine value in this content, hit the subscribe button right now and activate notifications. We cover exactly this kind of verified, actionable retirement planning information every single week. One click and you will never miss the next installment. Document number 4. This is the document that prevents you from being taxed twice on the same dollar, and it is the one that retirees with IRAs are quietly surrendering tens of thousands of dollars to without realizing it. Not because of anything improper or illegal, but simply because nobody has been keeping track of a number that should have been documented years ago. Here is the core situation. When most individuals contribute to an IRA, those contributions are tax deductible. You deposit the money, it reduces your taxable income for that particular tax year, and you pay the taxes when you withdraw the funds later in retirement. That is the standard traditional IRA arrangement. However, some individuals, particularly those with higher earnings or those whose income exceeded the deductibility thresholds in particular years, made what are referred to as non-deductible IRA contributions. They deposited after-tax money into the IRA, money they had already paid income taxes on previously. Here is the critical problem. If nobody tracks that after-tax amount, which is officially called your IRA basis, then once you begin taking distributions, the IRS treats every single dollar coming out as pre-tax money and taxes it all over again. You have effectively paid income tax on the identical dollar twice over. Allow me to illustrate with a concrete example. Throughout his working career, Richard made $50,000 worth of non-deductible IRA contributions. He never consistently filed Form 8606 to document this. Neither did the accountants he worked with previously. Now he is 71 years old and required to take distributions. Because there is no documented basis on record with the IRS, his custodian reports the complete distribution amount as fully taxable income. He is now being taxed on $50,000 that he already paid taxes on once before. At a 22% tax rate, that is $11,000 in taxes he should never have owed in the first place. Permanently gone. Form 8606 is the mechanism for documenting that basis. You file it alongside your annual tax return for every year in which you make a non-deductible IRA contribution. And if you have made past contributions without filing it consistently, you have the ability to submit amended returns in order to establish your basis going back through prior years. This document is also critically important if you have ever executed a backdoor Roth conversion, where you contribute to a traditional IRA and subsequently convert it to a Roth account. Without Form 8606 on file, the IRS has no record whatsoever that the original contribution was non-deductible. The conversion then appears fully taxable in their system when it genuinely should not be. Then pay very close attention to this next section, because document number 5 carries the highest dollar value of every document on this entire list for the seniors who qualify for it. And I told you at the very beginning of this video that there was one document that almost nobody knows even exists. This is the one. I want to be fully transparent with you here. There is a part of me that is effectively working against my own interests by revealing these documents to you, because the more you understand about filing them yourself, the less you need anyone like me to walk you through it. But the truth is, you earn this money, and you should not have to pay someone $300 to submit a free IRS document that takes roughly 15 minutes to complete. Document number 5. This is the most powerful document on this entire list. It is also the one that nearly no senior is aware of, and if you meet the qualifying criteria, it could return thousands of dollars per year directly into your pocket, beginning as soon as the following month. To fully grasp why this document matters so much, you need to understand a concept called IRMAA, which stands for the Income-Related Monthly Adjustment Amount. It is a Medicare surcharge, meaning an additional charge layered on top of your regular Medicare Part B premium that affects seniors whose income crosses specific threshold levels. Here is how the standard Medicare Part B premium structure works heading into 2026. According to cms.gov, which is the official website of the Centers for Medicare and Medicaid Services, the standard Part B premium is $220.90 per month. However, if your income exceeds certain defined levels, Medicare charges you a higher amount. Based on your 2024 income, which is the figure Medicare references when calculating 2026 premiums, single filers with income above $106,000 begin paying more. The first surcharge tier adds $81.20 per month to your premium. That means your monthly payment jumps to $302.10 for $102.10. For married couples filing jointly, IRMAA begins applying at $212,000 in modified adjusted gross income. The same tiered surcharge amounts apply individually to both spouses. Here is the specific trap that catches retirees off guard. Medicare does not examine your current income level. It examines your income from 2 years prior. So if you retired during 2024 and your income was elevated in 2024 because you worked through the first half of the year, completed the sale of a business, took a substantial IRA distribution, or received a pension payout, Medicare used that figure to establish your 2026 premium amounts. Even though your actual income dropped meaningfully the moment you retired, stop and think about that for a moment. You retired. Your income declined by 40, 50, perhaps 60% or more. Yet you are still being charged an IRMAA, a surcharge calculated from the final year you were employed. That is not a just outcome. And the Social Security Administration, through the IRS framework, built a correction mechanism directly into the system to address exactly this situation. That correction mechanism is Form SSA 44. Form SSA 44 is a life-changing event appeal. It formally notifies Social Security that they should evaluate your current income rather than your income from 2 years ago, because something significant has changed in your financial circumstances. There are 8 qualifying life-changing events that make you eligible to submit this form. The first is marriage. The second is divorce or annulment. The third is the death of a spouse. The fourth, and this is the most widely applicable one for retirees, is a work stoppage. Retirement itself, you simply stopped working. That qualifies. The fifth is a meaningful reduction in working hours, or overall income. The sixth is the loss of income-producing property, such as a rental property you no longer own or control. The seventh is the loss of pension income you were previously receiving, and the eighth is the receipt of an employer settlement payment in a prior tax year that temporarily inflated your reported income. Now allow me to walk you through the specific scenario I promised you at the very beginning of this video. The retired woman in Ohio who saved more than $4,000 within a single calendar year, beginning the month immediately following her submission of this form. Her name is Patricia. She is 68 years old. She retired from her position in May of 2024. Her 2024 income, which is the year Medicare is currently using to calculate her 2026 premiums, included 7 full months of her regular salary. As a result, her modified adjusted gross income for 2024 reached $142,000. Her resulting 2026 Part B premium came to $385.90 per month. That places her in the second IRMAA surcharge tier. In 2026, however, her actual income is $38,000, comprised of Social Security plus a modest pension payment. But Medicare has no awareness of that change unless she actively informs them. She submits Form SSA 44. She selects the work stoppage category. She provides documentation that demonstrates her projected 2026 income level. The Social Security Administration reviews her submission and reduces her premium back down to the standard rate of $220.90 per month. That is $165 per month returned directly to her, $1,980 per year. And because she filed early in 2026, she was able to recover the excess premiums that had been charged going all the way back to January. The total financial benefit for the year exceeded $4,000, and that represents just one individual. For a married couple where both spouses are subject to IRMAA surcharges and both have recently retired, the combined annual savings can reach $5,000, $6,000, or even beyond that figure, depending on which surcharge tier they were previously occupying. Form SSA 44 is available directly through ssa.gov. You can complete and submit it through the online platform, send it by mail, or deliver it in person to your nearest Social Security field office. You can also contact 1-800-7721-213 by telephone to request the form be sent to you. The overwhelming majority of seniors never file this document simply because they have never been told it exists. And now you have that knowledge. That is precisely the difference this video is designed to make in your life. Let me bring this all together for you. 5 documents. Here is where to locate each one and the specific action you need to take. Form W4P, covering pension, and IRA withholding, is available at irs.gov. Download the document, complete the withholding calculation worksheet, and deliver it to your pension administrator or IRA custodian. This is the ideal starting point for anyone currently receiving monthly pension or IRA distributions who suspects they are being over-withheld. Form W4V, covering Social Security withholding, is available at ssa.gov. Submit it by mail or deliver it in person to your nearest Social Security field office. This is most valuable for anyone whose Social Security benefit is at least partially taxable and who wants to eliminate an unpleasant April surprise, or for anyone who is currently over-withheld and losing money every single month as a result. Form 104-0-SR, your dedicated senior tax return, is accessible through all major tax preparation software platforms and directly at irs.gov. If you were born before 1961, this is your designated form. As confirmed in IRS Publication 554, ask your preparer to verify they are using it before you sign your return. Form 8606, which handles IRIA basis documentation, is filed alongside your annual tax return. If you have ever made non-deductible IRA contributions or completed a backdoor Roth conversion, this document safeguards your established basis. It is verified and explained in IRS Publication 590-B. If you have never filed it and should have been doing so, speak with your CPA about the possibility of submitting amended returns. Form SSA44, the IRMAA Life-Changing Event Appeal, is available directly at ssa.gov. If you have retired, experienced a reduction in income, or gone through any other qualifying life-changing event since the income year Medicare is currently referencing, submit this form immediately. Do not sit and wait for the next open enrollment window. This document can be filed at any point throughout the year, and here is the recommended priority sequence for tackling these. If you are only going to address one of them this week, begin with Form S, SA-44, if you are currently being charged an IRMAA surcharge. The per-month financial impact is the greatest of all five, and the correction takes effect quickly. Following that, address Form W4P if you are receiving pension or IRA distributions with withholding amounts that feel higher than they should be. Next, submit Form W4V to properly calibrate your Social Security withholding. Then confirm with your tax preparer that they are using Form 1040-SR for your return. And finally, if you have a history of making non-deductible IRA contributions, have a direct conversation with your CPA about Form 8606 and what may need to be filed or corrected. Let me tie everything together with the single most important idea that transcends every individual document on this list. In every single one of these situations, the form already exists within the system. The IRS already accepts it. The savings are already legally and rightfully yours. Form W4P is sitting on irs.gov right now at this very moment. Form W4V is waiting for you at ssa.gov. Form 1040-SR is embedded within every major tax software platform. Form 8606 is legally required for anyone who holds IRA basis. Form SSA44 has been available to seniors since the very beginning of the IRMAA system. Every single one is real, verified, and accessible, but not a single one is automatic. The government will not refund you for a form you neglected to submit. Nobody is going to mail you a check representing the appeal you forgot to file. The entire structure of the system is engineered so that money remains exactly where it is unless you proactively stand up and claim what belongs to you. These 5 documents are precisely how you do that, so do one thing for me right now. Forward this video to one person in your circle who is over 65 or approaching that milestone, a parent, a neighbour, a longtime friend from your congregation, because the odds are genuinely high that they are missing at least one of these 5 documents right now. A single share from you could translate into thousands of dollars for someone you care about. One final note before you go. Tax laws are subject to frequent revision, and the information presented in this video reflects the 2026 tax year, based on sources that were verified through May of 2026. Always consult with a licensed CPA, an enrolled agent, or a qualified tax professional before taking action on your specific situation. Your individual numbers are unique, and the details involved genuinely matter. Now here is exactly what I want you to do at this moment. If even a single one of these 5 documents was completely new information for you today, hit the like button. It takes 1 second, and it helps this video reach more seniors who genuinely need this information. Hit subscribe and activate the notification bell, because next week I'm going deep on precisely how to calculate the correct withholding figure when completing Form W4P, a full step-by-step walkthrough of the worksheet so you permanently stop overpaying every month.